Hello investors. So today what I'm going to show you is what we call is the capture ratio. But before we dive into it, I will first explain what actually is capture ratio. So basically, we all know when like the markets go in tandem, when market is performing, every index is performing usually, and when markets don't perform, when markets crash, everything crashes. So what capture ratio does is that it divides the overall market movement into two parts. One is when the market rises, how much that particular index rises, and then when market falls, how much that index falls. So as investors, what we would want is the index we are invested in rises more than the benchmark when the markets are rising and falls less than the market when markets are falling. Right, that way we will be able to earn more when markets are performing good and lose less when markets are not performing well. So basically right now markets have crashed and everybody would be looking to invest in the small cap index, right? So what I did is that in India, for investing in the small cap index, you have four options: small cap 50, small cap 100, small cap 250, and small cap 500. Now these are indexes which holds different number of stocks as their name suggests. So small cap 50 is basically a concentrated bet on 50 top most liquid stocks in the small cap index. Similarly, small cap 100, 250, and 500. So what I did is that I looked at past 20, 25 years crashes as well as gains, and then I tried to figure out which index was performing best when the markets were rising and was performing the worst when markets were not performing. So if you look at these numbers, so for example, if you look at GFC crisis, in GFC crisis, Nifty 50 index fell by 56%, whereas the small cap 50 index fell by 65%. Small cap 100 fell by 77%. Similarly, small cap 250 fell by 72%, and then small cap 500 fell by 78%. So what we can understand from this is that small cap 500 was hurt the most when the markets fell. Similarly, if we take one example of when markets rise, like the recent example, the post-COVID run, everybody knows that the markets performed pretty well after the COVID crash. So the Nifty rose to 24%. But if you look at small cap 100, it rose 455%. The small cap 250 index rose by 567%. So as you can see, the small cap does better when the markets are performing and then does worst when markets are falling. But amongst the four small cap indexes, the index which rose the most was small cap 250, and when the markets fell in the GFC crisis, small cap 500 fell the most. So by doing this analysis, what we can see is that uh, the index which performs, like if we take both of these together, the upside and the downside. So this number you see here is basically dividing how much it performs well when the markets are rising divided by how much it loses when markets are not performing good. So the number which is the highest, small cap 50, it basically captures most of the upside and least downside. That's why it has the highest capture ratio. But this is a blended number. If we look individually, these are the individual numbers. So as you can see, the index which fell most when the markets were not performing good is the small cap 500 index, and the index which also rose the most when the markets were performing good is the small cap 500 index. So if you are someone who's ready to accept the maximum volatility but also wants highest gains, then small cap 500 index is for you. But if you are someone who doesn't want uh, the fall to be as severe as, for example, a small cap 500 index and are ready to compromise a little on the returns, then small cap 50 is the index you should be investing in. So basically, we can conclude that if you are a risk averse investor, small cap 50 is your index, and then if you are okay with risk but want maximum upside, then the index you should be looking at is at small cap 500. Let me know your thoughts about this.